Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to sunny Los Angeles and speak with Mike Maloney of goldsilver.com and protectandsurvive.com, where I'll be speaking next week in London. Mike, welcome to the Keiser Report.
How you doing there, Max?
Fantastic. Mike Maloney, across Europe, member nations are being urged to use their gold reserves to collateralize euro bonds. What are your thoughts on what role gold will play in the final resolution of our global debt crisis?
See, all that gold was originally owned by the people. That was the people's gold. The central banks got it all, and now it's going to get transferred out of the central banks to somewhere. Gold used to back the currencies. Why is it now being used in repayment of debt? I think it's the worst thing that can possibly happen, Max. I think that, every 30 to 40 years, the world has a new monetary system. And before World War I, for most countries, they had a certain amount of gold at the Treasury, and they issued an equivalent amount of notes in circulation, a certain amount of units of currency that matched the number of units of gold that they had. Then World War I happened. The countries in Europe all stopped redemption rights. You could no longer turn in your currency and request gold. And then they lit up the printing presses. And so between the war, we had something called the gold exchange standard, where between the two wars, World War I and World War II, the gold exchange standard in the United States, for instance, the Federal Reserve Act specified that the currency only had to be backed 40% by gold. So in other words, they could put $50 in circulation for every $20 gold piece in the vault. And those $50 all promised to pay gold. So we were putting more receipts for gold or claim checks for gold in circulation than gold. The currency was the paper that circulated. The money, the real stuff, was in the vault, the stuff of intrinsic value. That fell apart during the Great Depression because it was a very poorly designed system. It was a man-made system. It fell apart. And they came up with the Bretton Woods system from 1944 to 71. And there was no reserve requirement. We could print as many dollars as the U.S. wanted to print and only have a certain amount of gold. All the other countries on the planet would back their currencies with U.S. dollars, and the U.S. dollar was backed by gold at $35 an ounce. And then Nixon stopped the convertibility into gold in 1971, and the world has been on a dollar standard since then. So we've gone on baby steps from gold to partial gold backing to less gold backing to no gold backing, where currencies are all backed by IOUs, bonds. Well, every 30 to 40 years this falls apart. Now we got to go back to something from nothing. If the central banks are going to use their gold to back debt, what are they going to have left when the world monetary system sees this next shift? I think the countries that do that are going to end up being broke, and the countries that still have some gold are going to end up being very rich.
Right. Now, China's, they're massively importing gold, and it seems to be a bit of a wealth transfer going on from the west to the east. Would you concur with that? What are your thoughts?
Absolutely. This is part of something called the 500-year east-west cycle. Every 500 years, roughly, prosperity and technological advancements shift from the east to the west and vice versa. A lot of people don't believe in the 500-year cycle. Some do. I just say that people can feel it happening today, and wealth is being transferred that direction. In regards to gold, for years, Western central banks were suppressing the price of gold by selling it into the market. Now, we've got, the past couple of years, central banks are net buyers of gold. This is a huge game changer. I wrote an article a long time ago, When One Country Blinks. That is happening right now. Countries are they're in a showdown, and countries are starting to blink. Venezuela asking for their gold. When the rush happens, I think you're going to see gold be going like this and this and this, and then suddenly, bam, there could be gap-up days where you see the price of gold go up 30% or even double. You wake up in the morning, the price is double what it was last night.
Well, certainly as you get further into a bull market, you have different dimensions of that market occur, and that kind of volatility, I think, is to be expected. Now, speaking of wealth transfer, since September 29th in the U.S., 650,000 customers have transferred $4.5 billion out of big banks into credit unions and community banks. How much more impact on the fraudulent banking system would this protest have made if each of these 650,000 customers had bought just 1 ounce of silver?
Well, you know, the silver market, I'm not sure the size of it right now. It used to be that the silver market was 1/300th the size of the gold market.
My understanding is that this above-ground silver supply is roughly worth about $1 billion. So here you have 650,000 people. If they each bought 1 ounce at this type of a level, they would have probably tripled the price of silver.
Yeah, you'd have $200 silver or $150 silver, something like that.
And would that have made a huge impact on the psychology of this market?
Yes, it would. I've been saying since 2002, $100 silver is an absolute no-brainer. And I'll tell you, when silver was $4.30 an ounce, $4.50, $5 an ounce, people thought I was a lunatic. And now that it has already hit $48 an ounce and then done a pullback, they're going, well, maybe he's not a lunatic. Now it only takes tripling of silver. Well, silver was $50 back in 1980. Name one other thing on this planet that's selling at a discount to its 1980 price, Max.
Computers. But, of course, that's another story.
That's a good one. You got me there.
Due to hedonic adjustments, that cheapening of the central processing unit of a computer is considered to be deflationary in the mix that the government reports. Therefore, the price of food and energy, the fact that they're going up, don't pay any attention to that. But speaking of fraud, what are your thoughts on the CME Group and MF Global story? Does this story have any significance for someone who may be invested in gold and silver via the paper market? MF Global, of course, was caught stealing customer money.
It's all going to have an impact, but I consider all of the things that are currently going on short-term noise in the big picture, the big scheme of things. No fiat currency has ever survived. In 1971, we began a grand experiment where all the world's currencies became fiat all at once. This is proven thousands and thousands of times that this does not work. There is no example of any fiat currency before 1971 surviving. They all eventually fail. So my real target for gold eventually is infinity dollars of the type of dollar that exists now, the unbacked fiat currency dollar. That will go to infinity dollars per ounce as far as the gold price. My target basically is gold should be higher in price than the points on the Dow. It should take 50 ounces or less probably this time around for gold to buy a single-family median price home in the United States. So per ounce, 1/50th of a single-family median price home or 1 share of the Dow. That's my price for gold. All of the things, they're all going to have an impact, but it's just one of the little jags on the way up to infinity.
Okay, so let's talk about that gold-Dow ratio for a second, because it's historically interesting. There are 2 times in the past where the Dow Jones and gold have reached 1-for-1 parity. 1980, of course, the Dow Jones was at 800. The price of gold was at 800. Then I think you go back into the 1930s, where the price of gold was something on the order.
Actually, the price of gold was $20.67 an ounce on a day where the Dow was at 40.22 points.
40. The Dow Jones was at 40. Boy, that was a good day to be long the Dow. But it was so at the 1-to-1 parity using this rule of thumb. You're saying gold with the Dow Jones at approximately 11,000 to 12,000 an ounce. Let's say the Dow Jones comes in and we have a 1-for-1 parity anywhere between 5,000 and 10,000 on the Dow. Kind of, is that what you're saying? Yeah,
if we go into big deflation, maybe gold peaks at $3,000 an ounce, but the Dow will be 1,500. I believe you're going to see a day where gold will be double the points of the Dow, simply because if you look at the Dow-gold ratio, it goes into a bubble and then it overshoots to the opposite extreme. It goes into a bigger bubble, overshoots further to the other side, and then we went into the biggest bubble in history recently, and it's reverting now. It's down to about 7 ounces of gold for the Dow, or in other words, gold's price is 1/7 of the Dow. But since we're coming off of a point where paper assets were more overvalued in the year 2000 than at any time in all of history, PE ratios were insane. Dividend yields were non-existent. And we're reverting back. It was 45 ounces of gold to buy 1 share of the Dow. So gold's price was 1/45th the points on the Dow. It's currently 1/7, so gold is catching up. But we've been so far out of whack that it's going to overshoot further to the opposite extreme. I think you're going to see gold at double the points on the Dow one day. I think a target of equal is a very sane target. That's normal. But if we go into a deflation, you could see gold at 3,000 and the Dow at 3,000 or even 1,500 if it goes to double the points of the Dow. If we go into hyperinflation, maybe gold would be $30 trillion an ounce and the Dow 15 trillion points. And still, gold will buy you the same amount of shares of the Dow, regardless of whether it's deflationary or inflationary. Gold's purchasing power should rise 7 to 14 times compared to stocks. In the year 2000, gold was the most unloved and ignored than it had ever been throughout all of history. For the first time in 1971, from then on, it was no nation's money. From 1980, it went into a brutal bear market from 1980, where it hit 850, to the year 2000, when it was only $250. And you know, it's up at 1,800 roughly, so it's just barely over double from its 1980 high, and they've created about 10 times more dollars. I mean, how many things are just double in society what they were in 1980? Almost everything is up far, far higher than that.
All right, well, certainly, you know, it's 15 trillion or 30 trillion. It sounds like really absurd numbers, but remember back in the Weimar German days in the 1920s, the Reichsmark went from a 1-to-1 ratio to the U.S. dollar to 5 trillion to 1 to the U.S. dollar. So getting into those trillion numbers, historically, you do see that from time to time. Mike Maloney, we're out of time. Thanks so much for being on the Keiser Report.
Thank you so much, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Mike Maloney. He's on Twitter at Mike_Maloney. You can follow me on Twitter, and please follow me on Twitter. I'm trying to stay ahead of Stacey Herbert on Twitter. And you can send me an email right here at KeiserReport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.